the Gould Mine podcast.
Right. So you're going from 500 to like a 575 basis, right? And so then you're only paying the, it is definitely an incentive, but I think the real juice is the non-taxable increase, or the non-taxable gain after the investment.
That's the big benefit for the whole program. And the nice thing, and the way that it works is, when I sell that Bitcoin, the situation for me being an investor who just realized the capital gain, and the thing about the program is, Danny, it's actually any kind of capital gain. Yeah, I mean, I could have sold real estate. Maybe I tried to do a 1031 exchange and I had a failed or a partial exchange. Well, this program's the second bite at the tax apple, so I can still take advantage of it. And when I take advantage of it in a 1031 situation where right now, 1031, I got to go from real estate to real estate. Like kind of exchange, right? With this, I could go from real estate and then put my money into a business. So it doesn't have to be like kind. I just have to put the money in a 180-day window. So the way that it works is when an investor realizes a capital gain, does not matter the source, doesn't matter long-term, short-term. I have 180 days is the general rule of thumb. Now there is an exception to that rule. If I sold real estate and I'm realizing the gain on a K1 at the end of the year, I can elect my 180 days to start December 31st at the end of the year versus maybe I sold the property in, let's say, January of that year. So, but by and large, the rule's 180 days. As an investor, I've got a situation. I'm either going to use the program or pay tax. So I put the money, capital gain money, into an opportunity zone fund. Then from there, the fund reinvests the money into something eligible, geographically located in an opportunity zone, whether that's some sort of like ground up real estate project or something that needs to be rehabbed, or a business for that matter. That's a startup. Okay. For me as the investor, I have to hold my investment position in the opportunity zone fund for 10 years. 10-year anniversary is when I realize that step up when I exit. So if I put the $1 million in and in 10 years at 10x to 10 million, that would be tax free to me as long as I stayed in the fund for 10 years. Now, again, going back to the very, very beginning of why people get misconceptions with, expiration dates of the program. For me as an investor, the program does not expire till 2047. There are going to be a lot of right situations where I may be a very long-term investor in an opportunity zone fund for a 20, 25-year window of time, because that entire time, all my growth is tax-free to me. So it could be a very, very unique situation in that sense. So now you get into a retirement planning strategy utilizing the program, right? That's number one. Number two, what makes this program very unique is that this is the first time that something like this type of program's ever been done in the history of our country.
Right.
There are 21 federal agencies that support the program. There's all 50 states at the state level and at the local level have support initiatives in place for the program. It's a tax stackable program. It's a program that does not involve trickle down economics, but it's something that you just do and then report. So it's not a permission-based program. It's not an approval-based program. It's not a grant-based program. It's a program that, because of how it works in its fundamentals of separation of entities, meaning that you have one entity that's a fund, you have another entity that's actually receiving the money. You can tax stack benefits. You can use leverage. So just like how you would do like a real estate development project, for example, you might go, in the capital stack, you might look at some, maybe some TIF money, some loan money, maybe some grant money in there, maybe some tax rebates, whatever cost seg study might end up indicating, right? An opportunity zone fund can come into that for an equity play and be part of that capital stack. There's no minimum. There's no maximum. So when you look at a deal perspective, especially with the changing dynamics today with real estate, higher interest rates, banks lending less, we have a shifting real estate market right now. And so, a fund comes in for equity in the deal. It could come in and do 20%. It could come in and do 100%. to where you completely, eliminate the need for a bank. But, it's a phenomenal program. It's just not a well-known program. There was a lot of in the very beginning, a lot of, cheerleading, rah-rah, siskumba at the federal level. And then we had COVID, we had a change in election, and really the program just kind of been running silently in the background. And your big money takes advantage of it. Your large-scale developers take advantage of it. Prime example of a business taking advantage of it, Chick-fil-A just did a press release that they moved the first time a franchise into Puerto Rico, and they did it utilizing the Opportunity Zone program and made that franchise an Opportunity Zone business. So you're starting to see this is something that can be widely used for community revitalization.
Wow. Yeah, that's actually, I want to dig into that a little bit more, because obviously anyone who is investing into that sort of business, right? Think about all of the money that a business like that is going to make. Now, a question that just came up, right? So there's two things. There's appreciation and there's cash flow. So to me, it sounds like the appreciation is protected by this Opportunity Zone program. The appreciation is going to be tax-free. What about the distributions and the cash flow that are produced by the real estate, that's produced by the business? What happens there?
Great question. So again, when you follow the call it the structure tree, right? Typically for this program, the business is going to be structured really one of two ways, either like an LLC, LP type structure, or a C Corp issuing stock. So first of all, it's going to depend on the business that the fund invested into. All right. Okay. More than likely what you're going to have is a K1 situation. So the business will K1 to the fund based on whatever percentage of equity that the fund has in said business structure, right? So let's just say 25% as an example. So, on $1 million profit, the fund's going to see $250,000 come back to it. Then the fund from there can do one of two things, either depending on the fund structure, which again is either going to be an LLC or a C Corp. It either can do a K1 distribution to the individual investors based on the percentage of equity that they own of the fund. And that investor will simply claim that as ordinary income tax. Okay. That's option number
Understood.
one.
Got
option
it.
number two is the fund can hold it, not do a disbursement, and reinvest it back into something else as long as it does it in a 12-month window of time and be shrouded from tax altogether.
Oh, wow. Yeah, this is a really interesting strategy. And that's through 2047. Are they thinking about pushing the 2047 date back too with this extension?
2057.
Oh, wow. So we're talking potentially over 30 years then of non-taxable gain.
Absolutely.
And you can roll the distributions back into it. Now, of course, people might. Okay, now question for you, right, David? So, and we're going to get into, what it is that you do with all of this. We kind of skipped full. I was so excited. All right,
we're diving right into
about the.
Hey, this is what everybody wants. Salad.
Yeah, no, this is so good, man. This is awesome. What a way to start season 2, by the way. And I lost my train of thought. That's how this goes.